All right, so in chapter 10, we're going to be looking at the part of the balance sheet where we're going to be dealing with liabilities. And of course, you all know at this point that liabilities is basically is your debt. All right, so again, the different types of liabilities that companies could have. So for example, and you've seen these before when a company buys goods and services on credit. Sometimes you might have to obtain some short-term loans if you have some cash issues where you don't have that cash inflow, so they may have to go to the bank and just float a short-term loan. And of course, sometimes you have long-term debt, okay? So again, the short-term loans, again, we're going to be calling these current liabilities. Again, remember, your current liabilities are what you pay within 1 year. And then, of course, the long-term debt will be debt that's longer than a year. And we'll get into a new type of debt that maybe some of you haven't done before, which of course is called a bond payable. Maybe some of the other types of long-term debt you've heard of is like a mortgage as well. All right, so again, having said that, let's take a look at the next slide. And of course, you can see on this slide an example of different types of, this is General Mills balance sheet. And you can see, taking a look at their current debt, they've got accounts payable. They have some accrued liabilities. Of course, that's kind of from your adjusting entries when you're doing some payroll accruals or tax accruals. Notes payable, and of course sometimes part of your long-term debt that you're paying off is considered current if you're paying it off in the current year. So you've got current debt, which again have to be paid within a year, and of course you have other things like long-term debt and then maybe other types of liabilities. But liabilities do play a role because lots of times companies don't have that cash flow to be able to make their operating expenses. So you do at some point in time sometimes have to borrow money to be able to make sure that your business stays intact. Okay, so again, typically you've got the idea of measuring liabilities. So typically you have the initial amount that you loan out or that you borrow out, the cash equivalent. Eventually, sometimes you might have more debt that you take on, and of course, the other issue is when you actually make the payment on your debt. So again, initial liability, when you borrow the money, of course you're going to increase cash, and then you're going to be crediting either a note payable or accounts payable. And then of course, if you borrow more money, you're going to be increasing that. And then of course, the other issue is when you actually make the payments, you'll of course be reducing cash, and then of course also reducing that liability. So again, accounts payable, I believe, is probably one of the more common types of debt you've already seen. And lots of times this is when you're buying some goods. Typically, your accounts payable are going to be paid probably within 30 to 45 days, usually. But typically when you buy something on credit, you'll increase it. And then, of course, whenever you pay it off, you're going to be decreasing it. Other types of debt, of current liabilities, again, be your accrued liabilities. These would be liabilities like payroll, taxes, things of that nature that you've actually incurred it and you got the bill, but you haven't paid it yet. But again, because of the matching principle and the rules of GAAP, that before you do your financial statements, you have to actually put those liabilities again on your balance sheet. And again, like as I said, payroll accruals are very common. And along with payroll, it's not just the salary that you have to accrue. You also have to look at any sort of income tax, FICA, Social Security, other types of things you have to look at depending on the pay period. And then, of course, have to make that accrual to make sure that, again, that liability gets reported in the right time period. And here's just some examples of, and again, you're not going to be tested on how to come up with all these actual payroll deductions, but they're just showing you in this example, for example, how they would arrive at the amount that they're going to be accruing. And again, they're just showing you all the different types of items that would go into pay. You've got, again, here's your federal taxes, FICA, other, and then of course, they're showing you that, of course, you'd have to then accrue some of these depending on the pay period and of course the accounting period. Okay. And on this one, they're just showing you the journal entry. Notice, again, you'd be debiting an expense account, and then you've got several different liability accounts. You've got, income taxes payable, FICA, United Way payable, and so forth. And so these types of liabilities, again, once you record those journal entries, that would then get reported on the financial statements. And then here's just another example of an entry that would need to be accrued, where they've got some unemployment tax, federal and state, and the FICA. And notice how you just are debiting a payroll tax expense and you're crediting the liabilities. And remember that anytime you do accrue these liabilities, you know, you're putting that expense on the income statement, which does impact your profits as well. Okay, and then of course you also have just the tax, you know, the tax issues as well that you're going to be accruing. And so in this case, you're just giving me an example. If you had owed taxes on $1 million at a 35% tax rate, you'd have to accrue that tax before you pay it, as long as it goes into that time period. So again, there's a little bit of the adjusting entry aspect of liabilities as well. Now, notes payable. Typically, the differences between notes payable and accounts payable is that with notes payable, you usually have interest. And so notice they got 4 key events. You borrow the money. You then have to look at the interest that you've incurred but haven't paid. You have to make a journal entry to actually pay the interest whenever it comes due. And of course, you have to not only pay the interest, but pay that principal that you borrowed. So again, that'll be some of the entries you have or issues that you have to deal with a notes payable. So the first slide here just shows you to how you would establish a notes payable. Again, you'd be borrowing money. Notice it says this is General Mills. They borrowed $100,000. It's on a 1-year note. The interest rate is 6%. And of course, they're going to have pay both of these back by October 31st, 2019. So to establish that, you would be debiting cash, crediting and notes payable, so you got the money. And then of course you have to watch out for your time period, because at that point you're going to have to start tracking your interest accruals as well. And remember the concept of interest. It's that big thing. It's called PRT, principal times rate times time. So the principal here would be at $100,000. The interest rate is 6%, and that's an annual rate. And then you just have to look at the time period. So in this case, look at the date. If they borrowed it on November, and now you're at December, that's 2 months later. And that's basically 2 months out of 12 months. That's the fraction of the year. Because remember, the interest rates that they'll give you are always an annual interest rate. So you're simply saying, how much do I owe for 2 months? So by following this formula, principal times rate times time, so 100,000 times that annual interest of 6% times 2/12 of a year, because it's November and December, that would give you approximately $1,000 of interest that you owe. So because you haven't paid it yet, you'd be debiting interest expense and crediting an account called interest payable, and that would be your interest accrual. So then in the next year, when you go to then pay that interest, of course, you have to pay the rest of the interest. So again, the principal times rate times time. The rest of that interest, notice it's 100,000 times 6%. It's the rest of the 10 months of the year. That's $5,000. So your total interest payment is $6,000. And notice how they divide the interest expense, which is for the next year, $5,000. And then of course you'd also have to debit that interest payable that you just established when you did that accrual. So again, this would be how you take care of that. And then the last step would then be to actually make the principal payment. And that's pretty simple. You just debit notes payable and credit cash for the amount that you had borrowed. And then a couple other types of current liabilities. Again, you could have sales tax payable. That's essentially the tax that you sell your product. You have to collect it from the customer and then later on pay the state. And of course, you could also have other issues like deferred revenues, where you've actually received money in advance, but you owe a service. So that liability, you don't actually have to pay in money. You have to pay in terms of some sort of service that you provide. And this example is just showing you again how you have to do some calculations on your sales tax. Notice there is saying if you have 5% sales tax that you collected, so at the time of sale, you have $1,000 of revenue, but notice you put that sales tax payable, that's your liability account, because at some point in time later on, you'll have to pay that back to your state government. And then again, the same thing with these sort of cash advances happens a lot. In the entertainment industry, the sports world, lots of times you get advanced ticket sales before you've actually performed the service. And notice you simply just debit cash and then credit that deferred revenue. And then once you actually started to perform or earn that, you simply just debit the deferred revenue and then credit your service revenue. So in this case, they're just telling you that they had earned half of that initial amount. And so debit deferred revenue by 4 and then credit your service revenue for $4 million. And then the other type of current liability you might see is just depending on your long-term debt. Once your long-term debt becomes due within the next year, that portion would be reported as a current liability. Okay, now we get into some of these things called long-term debts. So the one we'll probably spend the most time on is the bonds. But typically, just like you have a short-term note payable, you could also have a long-term note payable. That could be like a mortgage. And of course, you would still have interest to deal with, so the principal times rate times time. But the one that's going to be a little bit different is going to be this thing called a bonds payable. So again, bonds are what companies typically, they put their company name on it, and it's a promise to pay a face amount on the bond plus interest. That's what the investor is going to get back on the return when they lend the money to the company, is they want to get back their interest. So let's take a look at some key elements of a bond. So you'll note that typically there is always going to be a maturity date, a face amount, and a stated rate. The stated rate is what the bond is guaranteeing that they will pay you. So that's what the investors are looking at. And so you have a stated rate that they're guaranteed to get back, and the rate, the way you calculate the interest is the same as before, the principal times the rate times the time. And most of the bonds that you'll see are what they call corporate bonds. And they're usually sold in $1,000 increments. So we'll just use, like in this book, in most of our examples, is we'll use 1,000 per bond as the face amount. And you just multiply that by the interest rate that's given on the bond, that's the stated rate. And then depending on the time period, that would essentially be how much interest that the bond is required to pay. Okay, so the way bonds can be issued are basically 3 different ways. You have what is called a bond premium, a bond sold at face, and a bond sold at a discount. And remember, everything we're going to be doing here is comparing everything to a $1,000 bond issue, or in terms of the par, they call it the par value or the face amount. And so what happens is you look at the stated rate of the bond. Again, that's the required rate. And then you look at what the bond holders are looking at. And we often call this the market rate. And that's simply what other investments, what other bonds are paying in the marketplace. And so what happens is that you compare that stated rate on the bond to whatever the market rate is, and that will determine if the bond sells at premium, at the face amount, or at a discount. So the first scenario would be like if the stated rate of the bond is 6% and the market rate's 4%, so if our bonds are paying more than the market, that is pretty good. And so bondholders are willing to pay a little bit more for your bonds because they're going to get more return. So that would be called a bond premium. If the stated rate of the bond is equal to the market rate, then that's going to be what they call a face amount bond because it's the same as the market. If the bond stated rate is less than the market, that means that investors aren't going to be as willing to buy your bonds because they can get better interest return on other investments. That's why they say you're not attractive yet. So what you have to do is you have to do what's called a discount. You're going to sell the bond below face value. So again, a premium will be when your bond sells above the face amount. Notice in this case, you would sell the bond for an extra $7,260 above the face. On this one, you're selling it at face. And then at a discount, you'd actually have to reduce the price of your bond. So if the bond's face value is 100 and you discount it because of the interest rates, you'd only get $93,000 for your bond. And that's how the market works, because otherwise you would not be able to sell those bonds. Nobody would buy them. All right, so just a couple examples in terms of how you would do the recordings. So in this case, when you do the bond sale, the first one will be just a bond sold at the face amount. Notice you simply just debit cash, credit bonds payable for whatever the face amount. They said this is issued for, it's 100 bonds, so that's 100,000 at face amount. Notice you don't have to worry about any discount or premium. It's just simply pretty simple. You debit cash, credit bonds payable. That's all you got to do. Now, when you sell a bond at a premium, you'll notice that in this case, again, it's $100,000 is the face, but they're selling it for $107,260. Notice what they do. They debit cash for the amount that you're going to get from the proceeds. You still credit your bonds payable for the face amount. You always credit bonds for face. And then the plug number to make the debits equal the credits goes to this account called premium on bonds payable. Now, we're going to have to deal with this a little bit later on. But just for right now, just get the initial transaction and how you actually record the bond sale. So you debit cash, credit bonds payable, and then you would credit your premium on bonds payable. That's how it works. Now the discount is going to go just the opposite way. You'll notice you debit cash, but the plug number is going to be on the debit side. Notice bonds payable still gets credited for face. And because we're getting less money than the face, we need to plug in a debit, and that debit is going to go to this thing called discount on bonds payable. All right. So that would be the three different ways in terms of how you would record the initial sell of a bond, either face amount, premium, or discount. Now, the next issue to deal with is once you've actually issued these bonds is how do you come up with the interest. So again, we'll start with the face amount bonds. Pretty simple. You just take the principal times the interest rate, and then whatever time period you're looking at. In this case, it's 1 month. So because these interest rates are always annual, one out of 12 would be 1/12 of a year. So in this case, you would have accrued interest on that bond of $500. And you just debit interest expense and then credit interest payable. So the face amount bonds, again, are going to be the easiest because you don't have to worry about those premiums or those discounts. Now, regarding the premium, so the way this typically works is when you sold a bond at a premium, that means that you got more cash than the face amount. But remember, the interest that you're going to pay on any bond is always based on that face amount. So what's going to happen is we have to deal with that premium. So again, notice again, like I just said, you know, your cash proceeds are actually more than the face amount on the bond. But the fact is you're only going to pay interest on that face amount. So what happens is essentially your interest expense that you're going to record will actually be less than the interest that you paid, because what's going to happen is we're going to do this a little bit later on, is we're going to offset that interest paid by this premium. We're going to do what's called an amortization of bond premium. And when we do that, that's what's going to cause our interest expense on a journal entry to actually be less than the interest amount that we paid. And I think that's, again, I already mentioned it. So yeah, so again, we'll get this thing called premium amortization. And regarding that amortization, it'll just be a straight line method type of write-off of that amortization. But we'll do that again on the, there's a second part to this video because there's a lot of PowerPoint slides to go through. But when we get to the amortization, you'll see how there's a couple different ways in how you amortize. We'll do what they call straight line. And then there's also what they call effective interest rate method. And we'll deal with that later when we start to do some schedules. All right, and of course, just the opposite, when you have a bond discount, remember you would have received less cash than the face. And it's because of that, and remember, you're still paying interest on that face amount. What's going to happen because of that amortization is your interest expense will actually be reported as more than the interest that you paid. And that should fall out eventually when we start to look at some of the journal entries on bond discounts. All right, and so again, we'll do that on the second part when we'll walk you through the schedules on bond and amortization. All right, a couple more issues before we get to that. Sometimes, you know, because you remember bond is debt, long-term debt, and it does weigh on your balance sheet. So lots of times companies, what they'll do is they'll have agreements when they sell some of these bonds is they may want to retire them sometimes before they're actually mature. But in any case, all you do to retire a bond, of course, if this one is an example of the face amount, is you're going to be debiting that bond's payable and crediting cash. So again, that's assuming that it was just a face amount bond. But again, this early retirement comes up a lot because remember, when companies have these bonds, they're paying a lot of interest. That's a lot of interest payments. And that can be very costly. So sometimes it'll be advantageous for a company to eliminate that bond debt on their balance sheet, just to help them out with their cash payments and also their debt ratios. So in this example, they're just saying, what if they had a $100,000 bond issue and they're going to make 102 payment of the face, and the carrying value was 100,000. So if they're going to, in order to pay off these bonds with a carrying value of 100 and the cash payment is 102, they're actually going to lose another $2,000 on that retirement. And so what you would do is simply debit your bonds payable, again, for the face amount, debit that loss, which in this case would have been a 2,000 loss. And of course, you didn't pay the 102,000 you have to do to retire that bond and get it off your books. So again, it does a couple of things. That not only gets it off your books, but then you don't have to make that interest payment, which is going to be weighing down not just on the income statement, but also on a company's cash flows. Okay, and again, like I said, we'll deal with the amortization part of the bonds in the second part of the lecture video. The only other liability we're going to talk about that's left is what they call contingent liabilities. And contingent liabilities are potential liabilities that arise from some sort of event. And so typically what you do is you have to have some sort of rating. You got three different likelihoods. These are probabilities. You have what is called a probable event or probable liability, one that's going to be reasonably possible, or one that's going to be remote. And a very common thing could be like warranties, product defects, like like on cars. Companies sell cars. There could be defects on cars, and you have to estimate if you have to pay out damages. And these again are called contingent or again potential types of liabilities. So the only one we got to really worry about is if it's probable. And if you can estimate how much that debt's going to be, then you actually have to do an accrual. In this case, it was a legal expense, debit legal expense, credit payable. If the likelihood is probable, but you cannot estimate it in terms of the amounts, you don't have to accrue it, but you still have to somehow put it into your financial statements and say, we may have this potential liability, but you have to let your investors and creditors know about what's happening, as it could affect your future financial statements. And then the second scenario, if it's reasonably possible, the only thing you got to do about that one is you just have to put it in the notes to the financial statements. The one that's remote, you don't have to do anything about it because, again, it's remote and not likely to happen. Okay. And then the other couple of things is once you get past that, there's a couple of ratios to look at in this chapter. One's called the debt ratio, the debt to asset ratio. You're just comparing what you owe to what you own. And that's a pretty simple calculation. You just take your total liabilities and divide by your total assets. The other one is your times interest earned ratio, where you take your net income, you add back any interest expense and income tax expense, and then divide that by your interest expense. So those are a couple different ratios you're going to have to do. And so in this one, this is just showing you your debt ratio. And notice that when they took their total liabilities and compared them to the total assets, it makes up about 71%. So that just kind of tells you how much they're financing. And some might look at that and say that's a lot of debt. Usually you don't want to go past 50% or 0.5. So this might be a leverage situation where the company has a lot of debt, which could mean a lot of risk. So that might be a bad thing going forward. And then the other one, again, is just your times interest earned ratio. In this case, they just take their net income, add back the interest expense and income tax expense, divide by the interest expense. And of course, in this case, they got 9.07. It just means that they generated, again, 9.07 of income for the cost of financing. All right. So typically, this kind of tells you how quickly a company can grow. Again, they call it your times interest earned, and you typically want that number to be high. Okay. All right. So that's your times interest earned. Those are the two ratios you'll do in this chapter. And then the other part of this lecture video I'll get into is I'll show you how you do this, what they call the straight line amortization and the effective interest rate amortization of your bonds.